Hey there, welcome back to another video with Mind Money Masters with Cameron. Today we're going to talk about and explore the wide world of mutual funds. Now, before you start to yawn, this is just another video in our investing series that I want to cover. I want to cover quickly in this video what mutual funds are, various types of mutual funds, some benefits associated, and of course give you my final take on the mutual fund industry. Thank you for your support. Please remember to subscribe to my channel and comment in the feed below on anything that you liked or didn't like. Plus, let me know if I can talk about something in particular regarding the world of personal finance, investing, or making money online. Let's get started. So thank you again so much for watching my video. As I mentioned, today we're going to discuss the world of mutual funds. Just as a point of disclosure, all of my opinions are solely mine and not any form of professional advice or financial advice. I am not a licensed advisor. So you want to please work with your professional advisor before making any financial or investing decisions. The easiest way to describe a mutual fund is that it's a group of multiple investors that get together and give money to a money manager to invest however they deem appropriately. This is, of course, based upon a prospectus and a general summary of what the fund is going to invest in that the mutual fund gives every investor. But just from a basic understanding, imagine that there are 10 people around a table, and in that table is a bucket. Every person puts $100 of their own money into that bucket. The bucket now has, quick math, $1,000. Then they take that $1,000 and they give it to an investment manager who makes purchases and trades in the stock market associated with that expected type of investment that we learned about from the prospectus and the summary. Now, we will get into different types of specific mutual fund categories in the next slide, but initially mutual funds were created as a very inexpensive way to have a professional money manager. So you wouldn't have to actually go and get fee-based advisory necessarily. You could give your money to a mutual fund company and have the investment advisor do some investing on your behalf. Now, I would say that there are four main types of mutual funds out there. Either stocks mutual funds, bond mutual funds, commodities mutual funds, or a real estate mutual fund. As you can imagine, each one will invest in their corresponding asset. The major difference, though, between these and exchange traded funds that we talked about in a previous video is that mutual funds do not necessarily track an index. They use an index as a benchmark. Now, a benchmark is basically what they want to perform against or track against. Many of those benchmarks are the Wilshire 5000, the Russell 2000, or even the S&P 500 that we talked about in a couple other videos. Now, one common misconception, though, is that they do not actually track or mirror the index like an ETF. They are actively managed by the fund manager. So the fund manager can buy, sell different stocks within the mutual fund, different companies within the mutual fund on a day-to-day basis. Now, this can lead to capital gains within the fund. Capital gains is if you're selling it if you're holding an investment for a certain amount of time and you sell it at a profit, that's a capital gain. Now, that can be a long-term capital gain or a short-term capital gain. The issue here is that if you sell it, you could be subject to taxation, even though you personally haven't sold your mutual fund. The advisor who has gone in and made trades on your behalf has made sales that can cause a taxable event. Now, with any general rule, obviously, talk with the tax advisor for any specific questions, but I would say that you definitely want to check and see if there's any real serious tax ramifications associated with investing in a various mutual fund. As a general rule, though, you could get exposure to various asset classes within mutual funds. So, for example, if you invested in a stock mutual fund and a real estate mutual fund, you would get exposure to the real estate market within that mutual fund and exposure to the stock market within that other mutual fund. So potentially, and in theory, you might be able to diversify some of your market risk by getting into different asset classes. More on how to select funds, though, in my next video. The next video is going to actually be some investing techniques and some programs on how to get investing started within mutual funds. So there are several benefits to mutual funds in general that really should be considered. You can automatically invest in them. This is nice because you can basically set it up to where you have a certain number of dollars invested and it goes automatically into the fund and it continues no matter up, down market. You have constant investment process that keeps going into the market. You can automatically invest. You can treat them kind of like an account where you set the specific amount each month to go in. Now, since the fund is actively managed, you get an investment manager at the cost of just the fees tied to the fund, which in general are going to be less than an investment advisor fee. Now, also, since they are actively managed, you can invest in multiple companies at the same time without having to research every company. So, for example, in a stock mutual fund, they may have 30 or 40 different companies that they invest in, and you could potentially be quote unquote diversified amongst a specific sector of the market. So, why is this really important? Why do we even talk about mutual funds? Why do we care about mutual funds? One, they are extremely popular. The mutual fund industry is a multi-billion, if not trillion-dollar industry as part of the general financial industry. That's just mutual funds, not counting ETFs or options or any other type of industry. This is another investment vehicle to consider if you're looking for various ways to invest and grow your financial wealth. Purchasing mutual funds will completely take the guesswork out of investing and is very easy. However, have you ever heard of the adage, nothing worthwhile is easy? Well, if this is super easy, maybe it's not necessarily worthwhile since nothing easy is really worthwhile. One of the things that you can take away, though, you can take away complete control or thought process associated when you give your money over to the money manager. Now, they base their future performance potentially on past performance. Now, they don't say that they base their future gains on past performance because they specifically can't say that, but every prospectus shows what the fund has done in the past, so it is clearly an aspect of the decision-making process when buying into a fund. I don't necessarily think it's a good idea to give up complete control, though, with any investment. Remember, we talked a little bit about risk management earlier in another video. You want to be able to control your risk and manage your risk, not necessarily just hand your risk over to somebody else. I also have another video that I had mentioned earlier that will be coming out that's specifically around investing in mutual funds, so you want to take a look at that video as well. I will leave you, though, with this advice that the number one best way to invest in general is in yourself and your own financial education. I have a link in my description for a program that I highly recommend that will teach you how to grow any business and create your own business and build an incredible, awesome life. Please check out that link in the description, and also do me a favor, subscribe to my channel, comment on my video with what you liked and what you would like to see more of. I would be happy to create additional content based upon what you would like to see. Thank you so much for watching my video today. Cheers to your success and happy investing.